My wife left me for a client I'd introduced her to at a networking dinner I'd organized for my consulting practice. His name was Thomas Ashford. He was worth an estimated $40 million, according to the business journals that covered his real estate development company, and he'd apparently decided during our second meeting that he wanted my wife more than he wanted my professional services. I found out about the affair 4 months after it started, discovered through the same kind of mundane accident that reveals most hidden relationships. Rachel had left her phone on the kitchen counter while she was in the shower, and a text notification appeared on the screen from a contact listed as T with a heart emoji. The preview showed just enough to make the nature of their relationship unmistakably clear. Before we get into it, don't forget to like and subscribe, and hit hype to boost this episode. Drop a comment below with your city or country. I'm always curious where viewers are joining from. We'd been married for 9 years. I was 38, she was 36. We had no children, which later became one of the few mercies in the entire situation because there were no custody issues to complicate an already devastating divorce. I'd built a successful management consulting practice over the previous decade, working primarily with mid-sized companies on operational efficiency and strategic planning. My income had grown steadily from around $80,000 in my first year to approximately $300,000 annually by the time Rachel left, with some variation depending on how many clients I brought in and what kind of projects I landed. Rachel worked in marketing, though her employment had been sporadic and often part-time during our marriage. She'd started and abandoned several small businesses, consulting gigs that generated minimal income and required my financial support to cover the gaps. When she was employed, she typically earned between $30,000 and $50,000 a year. When she wasn't, which was roughly half the time we were married, she earned nothing, and I covered all our household expenses plus her personal spending. When I confronted her about the affair, she didn't deny it or apologize. She said she'd fallen in love with Thomas, that he could offer her a life I'd never be able to provide, that she was done with our marriage and wanted a divorce as quickly as possible. She moved out 3 days later, taking most of her belongings and staying in a luxury apartment that Thomas was paying for while our divorce proceeded. The divorce moved with shocking speed and aggression. Rachel retained Victoria Chen, an attorney who specialized in high net worth divorces and had a reputation for extracting maximum value for her clients regardless of the circumstances. I scrambled to find representation and ended up with David Park, a solo practitioner who charged a fraction of what Victoria's firm cost but who was clearly outmatched in terms of resources and strategic sophistication. California is a community property state, which meant everything we'd accumulated during the marriage was presumptively split 50-50. But the reality of how that worked out was far more complicated and significantly more tilted in Rachel's favor than a simple even division would suggest. The initial settlement proposal that Victoria presented was breathtaking in its audacity and its disregard for basic fairness. Rachel was demanding half of all marital assets, which was standard, but she was also claiming that my consulting practice's value as an ongoing business should be calculated and divided, that my future earning potential should be considered in determining spousal support obligations, and that various expenses she'd incurred during the marriage for her failed business ventures should be treated as marital investments that I owed her compensation for. The math worked out to Rachel receiving approximately $400,000 in immediate assets and property, plus spousal support of $6,000 per month for 5 years, plus a percentage of my consulting practice's future earnings for the next 3 years. The total value of what she was demanding exceeded everything I'd accumulated during our entire marriage and would have left me with substantial ongoing obligations that would take years to satisfy. I tried to negotiate through David, pointing out that many of Rachel's claims were unreasonable and unsupported by California law. But Victoria was relentless, and Rachel was motivated by what I increasingly realized was not just a desire for financial security, but actual vindictiveness. She wanted to punish me for not being Thomas Ashford, for not being able to offer her the lifestyle that a $40 million real estate developer could provide. The divorce was her opportunity to extract compensation for the years she'd wasted being married to someone she now viewed as inadequate. David advised me that we could fight the more extreme demands in court, but litigation would be expensive and time-consuming. Family court judges had broad discretion in dividing assets and setting support obligations, and there was no guarantee we'd get a better outcome than the settlement Victoria was proposing. He recommended I consider accepting a modified version of their demands to avoid the costs and uncertainties of trial. I was exhausted, emotionally devastated, and financially strained from legal fees that were already approaching $30,000. I agreed to a settlement that was slightly less onerous than Rachel's initial demands, but still stripped me of most of what I'd built over 9 years of marriage. The final agreement gave Rachel half of our savings, approximately $90,000. She received the newer of our 2 cars, worth about $35,000. She got various investments and retirement accounts that I'd funded primarily from my consulting income, totaling another $120,000. and she received spousal support of $4,000 per month for 4 years, which would total nearly $200,000 in ongoing payments. Altogether, Rachel walked away from our marriage with approximately $450,000 in immediate and future value. I kept the condo we'd lived in, which had about $100,000 in equity, but also came with a mortgage I'd be solely responsible for. I kept my consulting practice, but with significant ongoing financial obligations that would constrain my ability to reinvest in the business or save for my own future. Rachel was confident, almost smug, when we signed the settlement documents. She said something I'll never forget. "This is how it's going to be. You made good money, but you never understood how to really build wealth. Thomas will teach me things you never could." The contempt in her voice was unmistakable. I wasn't just someone she'd stopped loving. I was someone she viewed as a failure, someone who disappointed her by not becoming wealthy enough to satisfy her aspirations. Before we get into what happened next, don't forget to like and subscribe, and hit hype to boost this episode. Drop a comment below with your city or country. I'm always curious where viewers are joining from. What shielding meant what Rachel didn't understand. What her expensive divorce attorney, Victoria Chen, apparently never thought to investigate thoroughly during the settlement negotiations, and what I'd never explicitly discussed with Rachel during our 9 years of marriage, was the extensive degree to which I'd been financially protecting her throughout our entire relationship. The protection had become so routine and automatic that I'd stopped thinking about it consciously, treating it as just part of how our marriage worked, rather than as something unusual or requiring special recognition. The protection hadn't been dramatic or illegal. I hadn't hidden assets in offshore accounts or engaged in fraud or violated any laws. I'd simply structured our finances in ways that kept certain risks and obligations under my name rather than exposing Rachel to them, and I'd managed various complications that arose from her sporadic employment history and repeatedly failed business ventures without making them into problems that would affect her credit score, her ability to get loans, or her overall financial standing. The most significant example involved taxes, which had become increasingly complicated as Rachel cycled through different entrepreneurial attempts over the years. During our marriage, she'd started and abandoned at least 5 different small business ventures. There was the online boutique selling artisanal jewelry that lasted 8 months and generated maybe $3,000 in revenue against approximately $12,000 in expenses. Then the social media marketing consultancy that she'd launched with great enthusiasm, acquired 2 small clients, and let fade away after 6 months when the work turned out to be more demanding than she'd anticipated. The lifestyle blog that was supposed to generate income through sponsored content and affiliate marketing, but never attracted enough readership to be monetizable. The event planning service that booked exactly 1 wedding before Rachel decided she didn't enjoy the stress of dealing with demanding clients. And most recently, the wellness coaching business that required expensive certification courses and marketing materials, but attracted 0 paying customers before Rachel gave up on it. Each of these ventures had been treated by Rachel as a serious business endeavor during the startup phase. She'd registered business names, opened business bank accounts, purchased equipment and inventory and software, created websites and marketing materials. But none of them had been approached with the discipline and financial management required to actually succeed as businesses. Rachel would dive in enthusiastically, spend money freely on whatever she thought the business needed, fail to track expenses or maintain proper records, and then lose interest when the work became tedious or the revenue didn't materialize as quickly as she'd hoped. From a tax perspective, these failed businesses created significant complications. Each year when tax season arrived, I'd work with my accountant, Michael Chen, to sort through the mess of Rachel's business activities and figure out how to properly report them on our returns. We'd go through bank statements and credit card records trying to categorize her expenses, separate legitimate business costs from personal spending, and determine what could defensibly be claimed as deductions. The challenge was that Rachel's record keeping was virtually non-existent. She'd use her business credit card for personal purchases and her personal card for business expenses, mixing everything together without tracking what was for what purpose. She'd buy things claiming they were business investments, but then use them primarily for personal purposes. She'd claim home office deductions without maintaining any documentation of what space was actually used exclusively for business. She'd categorize expenses as business costs that were really personal spending loosely related to her business activities. Michael and I would spend hours each tax season reconstructing Rachel's business activities from fragmentary records and trying to create defensible positions on what could and couldn't be claimed as business deductions. Some expenses we'd claim knowing they were borderline but believing we could defend them if questioned. Others we'd exclude entirely because there was no reasonable argument that they were legitimate business costs. The approach we took was to claim maximum legitimate deductions while staying within the bounds of what we could defend in an audit. That meant Rachel's businesses showed substantial losses each year that flowed through to our joint return and reduced our overall tax liability. Her losses offset my consulting income, which was taxed at higher rates, resulting in significant tax savings for us as a household. But here's what Rachel never understood, and what became crucial after our divorce. Filing joint returns meant we were both jointly and severally liable for everything on those returns. If the IRS ever audited our returns and found problems with how Rachel's business expenses were categorized or documented, they could assess additional taxes, penalties, and interest against both of us. Rachel wouldn't be solely responsible for fixing problems with her business deductions. We'd both be liable, which meant the IRS could come after all of our joint assets and could pursue either of us individually for the full amount owed. I'd been absorbing that risk consciously and deliberately throughout our marriage. I'd kept detailed records in case we were audited, documenting the reasoning behind every questionable deduction, and gathering whatever evidence we could to support our positions. I'd worked closely with Michael to ensure that even our most aggressive tax positions had some reasonable basis in fact and law. I'd been prepared to defend our returns if challenged, and I'd structured our finances so that if we did end up owing additional taxes, I had the resources to pay them without devastating our household budget. But the risk was real and ongoing. Tax returns can be audited up to 3 years after filing, or 6 years in cases of substantial underreporting of income. That meant at any given time, we had potential tax liability exposure from multiple years of returns. That included Rachel's questionable business deductions. I was protecting Rachel from that exposure by managing it carefully and being prepared to deal with consequences if they arose. I'd also been covering various financial gaps and smoothing over problems that arose from Rachel's poor money management skills and general lack of attention to financial details. This went beyond just the tax complications and extended into virtually every aspect of how she handled money. Rachel had a pattern of bouncing checks because she didn't track her account balance properly, or because she'd spend money she knew wasn't available yet, assuming it would somehow work out. This happened regularly, maybe once every few months on average. Each time, there would be overdraft fees from the bank, returned payment fees from the merchants whose checks bounced, and sometimes additional consequences like suspended accounts or damaged relationships with vendors. I'd developed a routine for handling these situations. Rachel would call me, usually embarrassed but also somewhat defensive, to let me know a check had bounced. I'd immediately transfer money from my account to hers to cover the deficit and the fees, contact the merchant to apologize and arrange payment with the additional charges they'd incurred, and sometimes negotiate to waive fees or minimize the damage to her account standing. The costs were usually a few $100s each time, small enough not to be financially devastating, but frequent enough to add up over the years. I'd also handled credit card debt that Rachel had accumulated through spending patterns she couldn't sustain on her irregular income. She'd run up balances on multiple credit cards, making minimum payments when she had income and missing payments entirely when she didn't, letting interest and late fees accumulate until the balances became overwhelming. At several points during our marriage, I'd intervene to pay down her credit card balances before they spiraled completely out of control, transferring thousands of dollars to eliminate debt that was destroying her credit score and putting her at risk of legal action from creditors. One specific instance stood out in memory. About 4 years into our marriage, Rachel had accumulated nearly $30,000 in credit card debt across 5 different cards. She'd been using the cards to fund one of her business ventures and to maintain a lifestyle that her actual income couldn't support. The monthly minimum payments had grown to over $800, which she couldn't consistently afford, and she'd missed several payments, resulting in late fees, penalty interest rates, and increasingly aggressive collection calls. I'd discovered the full extent of the problem when a collections agency called our home phone looking for Rachel. She'd been hiding the debt from me, embarrassed about how bad it had gotten, and hoping she could somehow fix it on her own. When I finally got her to show me all the statements and explain the situation, I was shocked by how deep the hole had become. We'd had a serious conversation about responsibility and financial management. Rachel had promised to be more careful and to consult me before making major purchases or taking on new debt. And I'd paid off all $30,000 of her credit card debt using savings I'd accumulated from my consulting income, effectively erasing years of her financial mismanagement in a single transaction. That payment had been positioned as a loan from me to her, something she'd eventually repay once she got her business profitable or found stable employment. But of course it had never been repaid, had eventually just been absorbed into our general marital finances and forgotten. The $30,000 I'd spent cleaning up Rachel's credit card problem was effectively a gift, though neither of us had explicitly acknowledged it as such at the time. I'd also protected Rachel by structuring ownership of assets in ways that shielded her from liability. The condo where we lived was titled in both our names under California community property law, but I'd made the entire down payment of $70,000 from my business savings, and I'd made every single mortgage payment over the 7 years we'd owned it. The mortgage was in both our names because the lender required it for a joint property purchase, but I was the only one whose income had been used to qualify for the loan and the only one whose credit score and employment history had been evaluated. That structure meant if we'd ever defaulted on the mortgage or had financial problems related to the property, it would affect both of our credit scores and both of our financial standings. But Rachel had never contributed to the mortgage payments or taken any responsibility for managing that obligation. I'd absorbed all the risk while she'd enjoyed the benefit of living in a nice condo in a good neighborhood. Similarly, investment accounts and retirement accounts were titled in my name, even though California community property law meant Rachel had a legal claim to half of everything accumulated during the marriage. I'd chosen to structure them this way partly for simplicity in management and partly because my income was funding all the contributions and Rachel's sporadic employment meant she didn't have her own retirement accounts to worry about. Business credit cards and lines of credit I used for consulting work were solely in my name. This meant any business debts I incurred, any late payments or defaults, any complications from client non-payment or project overruns would only affect my credit and my financial standing, not Rachel's. She was completely insulated from the business risks inherent in running a consulting practice, even though she directly benefited from the income that practice generated. All of this financial structuring and risk management had been done out of loyalty, partnership, and love. I'd viewed it as my responsibility as the higher earner and the financially more sophisticated spouse to protect Rachel from complications she couldn't handle herself. I'd never discussed it explicitly or asked for recognition because it seemed like just part of what you did in a marriage where one partner had strengths the other didn't. But now we weren't married anymore, and the settlement we'd signed was based on Rachel's assumption that she could walk away with half of everything we'd accumulated while leaving behind all the complications, risks, and obligations that I'd been managing on her behalf. The decision. After signing the settlement agreement and watching Rachel leave with Thomas Ashford to start their new life together, I spent several weeks in a kind of numb fog. I was processing the emotional devastation of losing my marriage, the financial hit of giving up years of accumulated wealth, and the practical challenges of restructuring my life and my business to account for the ongoing spousal support obligations. During this period, I had several meetings with my accountant to discuss tax planning for the coming year. Our divorce had been finalized in September, which meant we'd need to file separate returns for the final few months of the tax year and going forward. My accountant asked routine questions about how we should handle various items that had previously been on our joint returns. That's when it hit me. The divorce decree said Rachel and I were no longer married as of the finalization date in September. That meant we were no longer filing joint tax returns, which meant we were no longer jointly liable for anything on those returns going forward, which meant I was no longer responsible for protecting her from tax complications or financial risks that had been shared when we were married. I made a decision in that moment, not to attack Rachel or expose her or seek revenge in any dramatic way, just to stop absorbing risks and obligations that were no longer mine to carry, to step back from the financial shielding I'd been providing throughout our marriage and let reality catch up with her. I didn't owe her that protection anymore. We weren't partners. We weren't building a life together. She'd made clear through her words and actions that she viewed our marriage as a waste of her time with someone who couldn't provide the wealth she wanted. Fine. She could have what she'd negotiated in the settlement, but she wouldn't continue to benefit from the financial management and risk absorption I'd been providing without acknowledgement or appreciation. The decision wasn't emotional or vindictive. It was simply accurate. If we were truly separating our lives and finances, then that separation needed to be complete and honest. Rachel would get exactly what the settlement said she'd get, nothing more and nothing less, and I would stop doing the extra work of managing complications that were actually hers to deal with. The action. The first step in implementing my decision to stop providing financial protection was to file amended tax returns for the previous 3 tax years, which represented the maximum period where changes could still be made and corrected without triggering more complex legal procedures. This wasn't about hiding income or committing fraud or engaging in any kind of illegal tax avoidance. It was about accurately representing what had actually happened during those years and who was truly responsible for various income sources, expenses, and deductions. I scheduled an extended meeting with my accountant, Michael Chen, and explained the situation in detail. I said I wanted to review our joint tax returns from the previous 3 years with fresh eyes, now that Rachel and I were divorced and our financial interests were completely separate. I wanted to determine whether there were items that had been attributed to me or structured in ways that minimized our joint tax liability that weren't entirely accurate or appropriate now that we needed to be thinking about our finances as 2 separate individuals rather than as a single household unit. Michael understood immediately what I was getting at and why the timing mattered. He'd been handling my taxes for over a decade and had worked with me through all of Rachel's business ventures and financial complications. He knew better than anyone how much accommodation and risk management I'd been doing to make our joint returns work, while minimizing both our tax liability and our audit exposure. We pulled up our returns for the previous 3 tax years and went through them methodically, line by line, reviewing every significant item and questioning whether the categorization and attribution were truly accurate or whether they reflected the protective financial structure I'd been maintaining during the marriage. What we found was extensive and revealing. Rachel's various business ventures during those 3 years had generated substantial losses that we'd claimed as deductions on our joint returns. The losses were legitimate in the technical sense that she'd actually spent the money and hadn't generated revenue to offset those expenses. But the way individual expenses had been categorized and documented was questionable in numerous instances. For example, Rachel had claimed home office deductions for 3 different businesses during this period, deducting a percentage of our mortgage, utilities, and home maintenance costs as business expenses. The IRS allows home office deductions only for space used regularly and exclusively for business purposes. But the reality was that Rachel's home office was a corner of our bedroom where she kept a desk and some business materials. She didn't use the space exclusively for business. She'd do personal activities there, store personal items there, use the computer for both business and personal purposes without any meaningful separation. Michael and I had originally claimed the deductions knowing they were borderline but believing we could defend them if questioned by arguing that Rachel did conduct substantial business activities from that space. But now, reviewing the claims with separate financial interests in mind, it was clear that the deductions were overstated and not fully defensible. The space wasn't used exclusively for business, and the percentage of home costs we'd allocated to business use was higher than could be reasonably justified. We identified similar problems with equipment and technology purchases that Rachel had claimed as business expenses. She'd bought computers, cameras, software, office furniture, all categorized as business assets and deducted accordingly. But many of these items had been used primarily for personal purposes, with only marginal business use that didn't justify treating them as fully deductible business expenses. We found entertainment and meal expenses claimed as business costs that were really personal spending loosely related to Rachel's business activities. Lunches with friends who might potentially become clients someday, dinners at nice restaurants where business was theoretically discussed but which were primarily social events, conference attendance and travel that combined legitimate business education with personal vacation activities. Vehicle expenses were another problem area. Rachel had claimed significant mileage deductions for using her car for business purposes, but her mileage logs were incomplete and clearly inflated compared to what her actual business activities would have required. Michael and I went through each questionable deduction and made decisions about what could legitimately be defended versus what should be removed or reduced on amended returns. We took conservative positions, erring on the side of excluding deductions rather than defending borderline claims now that my interests and Rachel's were separate. The amended returns we prepared reduced our total business loss deductions by approximately $92,000 across the 3 tax years. That meant we owed additional taxes on income that had previously been offset by Rachel's business losses. The total additional tax liability was approximately $48,000 when you included both federal and state taxes, plus interest on the amounts that should have been paid with the original returns. Under the divorce settlement and under basic principles of equitable allocation, Rachel and I were each responsible for half of any joint tax obligations from the period when we were married and filing jointly. So she owed $24,000 and I owed $24,000. But the impact went far beyond just that immediate tax bill. The amended returns established a different baseline for Rachel's business activities and their tax treatment going forward. If the IRS ever audited Rachel's individual returns from periods after our divorce, they'd see that we'd corrected the treatment of her business expenses in the amended joint returns. That would raise questions about whether she was properly categorizing expenses on her new returns, and it would make it much harder for her to defend aggressive deductions since we'd already acknowledged that similar deductions on our joint returns had been inappropriate. More immediately, the amended returns affected the divorce settlement math in ways that Victoria Chen would immediately understand even if Rachel didn't. The settlement had been calculated based on financial disclosures that showed my income and Rachel's business losses in a certain way. Changing those numbers through amended returns meant the underlying financial picture had shifted, which could potentially support arguments that the settlement terms should be recalculated based on the more accurate information. I also filed complete and meticulously accurate financial disclosures with the family court, updating the documents I'd originally submitted during the divorce proceedings. During any divorce in California, both parties are required to submit detailed financial declarations under penalty of perjury, listing all assets, all debts, all sources of income, all monthly expenses, and essentially providing a complete picture of their financial situation. These disclosures are supposed to be updated if material changes occur or if errors in previous disclosures are discovered, and they form the basis for how courts make decisions about property division and spousal support obligations. My original financial disclosures during the divorce had been accurate in the narrow technical sense that the numbers I'd reported were true. But they'd used the same protective financial structure I'd maintained throughout the marriage, where various obligations were listed under my name and various risks were attributed to me even when they were really Rachel's responsibility or should have been shared between us. The structure had made my financial position look stronger and more stable than it actually was when you accounted for all the hidden liabilities and ongoing management I was doing for Rachel's benefit. And it had made Rachel's position look simpler and cleaner than reality because all the complications and risks were being absorbed by me rather than showing up on her side of the ledger. Now I prepared amended financial disclosures that accurately represented the actual ownership and responsibility for various financial items, without the protective structure that had been benefiting Rachel. I worked with David Park, my attorney, to make sure the amended disclosures were properly formatted and complied with all court requirements, and I gathered supporting documentation for every significant item to ensure everything could be verified if questioned. The amended disclosures showed business debts that Rachel had incurred for her various failed ventures as her obligations rather than as joint marital debts we shared equally. These totaled approximately $18,000 spread across several credit cards, business loans, and vendor accounts that were in Rachel's name but that I'd been managing and paying down during our marriage to protect her credit. They showed credit card balances that Rachel had run up for personal spending, separate from business expenses, as her individual obligations rather than as household debt. These totaled another $12,000 that I'd been planning to pay off eventually but hadn't gotten around to before we separated. They showed the $24,000 tax liability from the amended returns as Rachel's responsibility, since it resulted from corrections to her business expense deductions rather than from any changes to how my consulting income was reported or taxed. They showed various other small debts and obligations that I'd been covering or managing on Rachel's behalf, each one individually minor but collectively significant. Membership fees for professional organizations that Rachel had joined and never used, subscriptions to business services she'd signed up for and forgotten about, deposits for event space she'd booked for her event planning business and never followed through on. Altogether, the amended disclosures showed that Rachel had approximately $58,000 in debts and obligations that she was solely responsible for, compared to the original disclosures that had shown her as having minimal individual debt, and most obligations being shared joint marital debt that we'd split equally. The disclosures also corrected the allocation of certain assets to accurately reflect who'd actually funded them and who had ownership rights. Investment accounts that were titled in my name but the California community property law treated as joint assets were now shown with annotation, noting that contributions had come entirely from my consulting income, none from Rachel's sporadic employment or business activities, and that the growth in value had occurred through my management and investment decisions rather than through any contribution or effort from her. The condo was shown as jointly owned as required by the title and deed, but with detailed notes documenting that I'd made the entire $70,000 down payment, had made every single one of the 84 monthly mortgage payments since we'd purchased it 7 years ago, had paid for all maintenance and improvements, and had sole responsibility for the mortgage debt going forward after the divorce, even though Rachel would receive half the equity under the settlement. Retirement accounts were similarly annotated to show that despite California law treating them as community property subject to division, every dollar in those accounts had come from my income and my contributions, with zero contribution from Rachel during our entire marriage. The impact of these amended disclosures was to show that while Rachel was receiving substantial assets and cash through the divorce settlement, she also had substantial existing obligations and debts that would need to be paid from those assets. The settlement had looked extremely favorable to Rachel when calculated against original disclosures that showed her as receiving $450,000 in value with minimal debt or obligations. But when calculated against amended disclosures that showed her actual financial position, including $58,000 in debt she was solely responsible for, plus ongoing tax obligations and credit issues that would need to be managed, the settlement looked much less attractive, and her actual net financial position was significantly weaker than she'd understood or anticipated. For Victoria Chen, who was sophisticated enough to understand how financial disclosures work in divorce proceedings and what implications arise when numbers change significantly, this would be an immediate red flag that the settlement might have been negotiated based on incomplete or inaccurate information. If she wanted to challenge the amended disclosures or argue that they were wrong, She'd need to explain why my original disclosures had been more accurate, which would be difficult since the amended versions were supported by bank statements, credit card records, tax returns, and other documentation that showed exactly where debts and obligations actually existed. If she wanted to argue that the settlement should be recalculated based on the amended disclosures, she'd be opening up a process where a judge would review the complete financial picture and make new determinations about property division and support. That could potentially result in changes that favored Rachel if the judge viewed some of my positions as too aggressive, but it could also result in changes that favored me if the judge determined that the original settlement had given Rachel too much based on incomplete disclosure of her actual debts and obligations. The safer path for Victoria and Rachel was to accept that the amended disclosures were accurate and that they showed a financial reality that was less favorable for Rachel than what had been assumed during settlement negotiations. The settlement would stand as written, but the underlying financial truth was now properly documented and visible to anyone who reviewed the court file. The shift. The amended financial disclosures changed the mathematical foundation of the divorce settlement in ways that Victoria Chen apparently understood immediately, even if Rachel didn't. The original settlement had been negotiated based on financial declarations that showed me as having substantial assets, strong income, and manageable obligations. Rachel had been portrayed as having minimal income, but also minimal debts and complications. The split of assets and the spousal support amount were calculated using those figures as the baseline. But the amended disclosures shifted the numbers significantly. My assets were somewhat lower because various items that had been listed as joint or as mine were now correctly attributed to Rachel. More importantly, my obligations were lower because debts and liabilities that I'd been absorbing during the marriage were now properly shown as Rachel's responsibility. At the same time, Rachel's financial position looked much worse in the amended disclosures. She had debts from her business ventures that hadn't been fully accounted for in the original settlement. She had tax obligations from the amended returns that she'd need to pay. She had credit card balances and other expenses that had been obscured when I was covering them but were now visible as her personal obligations. The settlement had assumed Rachel was walking away with $450,000 in assets and support payments, with no significant debts or obligations beyond normal living expenses. But the amended disclosures showed she actually had substantial existing obligations that would eat into that settlement amount, and she had ongoing tax and debt issues that would continue to affect her financial stability. For Victoria Chen, who was sophisticated enough to understand financial disclosure games and their implications, this was an immediate problem. The settlement she'd negotiated was based on a financial picture that was no longer accurate, and if those amended disclosures became the official record, it could potentially be challenged or reopened based on the argument that the original agreement had been based on incomplete or inaccurate financial information. More practically, the amended disclosures revealed that Rachel's actual net worth post-divorce was going to be much lower than what the settlement suggested. She'd still receive the same cash and assets we'd agreed to transfer, but she'd immediately owe $24,000 in additional taxes. She'd have business debts that I was no longer covering. She'd have credit card obligations and other financial complications that had been hidden when I was managing them, but were now going to surface as her responsibility. The settlement no longer looked like the clean victory Rachel had been celebrating. It looked like a deal that had been negotiated based on incomplete information, and one that was going to leave her in a much more precarious financial position than she'd anticipated. The call. Victoria Chen called my attorney David Park 6 days after I filed the amended financial disclosures with the court. David called me immediately after hanging up with her to relay the conversation and ask how I wanted to respond. Victoria's tone had been professional, but noticeably different from the aggressive certainty she'd projected during the settlement negotiations. She'd asked whether David and I would be willing to have a discussion about clarifying some numbers and potentially adjusting certain allocations in the settlement agreement. She'd explained that, upon review of the amended disclosures, she and her client had some concerns about how certain items had been categorized. She thought there might be room to revisit some of the terms we'd agreed to, particularly around the division of debts and the calculation of spousal support, to ensure that the settlement accurately reflected the parties' true financial positions and obligations. David said Victoria had been careful not to admit that there were problems with the original settlement or that Rachel was facing unexpected obligations. But the subtext was obvious. They wanted to renegotiate because the amended disclosures had revealed that Rachel's financial position was significantly worse than what they'd understood when the settlement was signed. Victoria had specifically asked about 3 things. First, whether we could adjust the characterization of certain debts to treat them as marital obligations that I would continue to be responsible for, rather than Rachel's individual obligations as the amended disclosures showed. Second, whether we could recalculate the spousal support amount based on the original financial disclosures rather than the amended ones, which would result in higher monthly payments. Third, whether I would agree to indemnify Rachel against any additional tax liabilities that arose from the amended returns or from future audits of our previous joint returns. All three requests were attempts to restore the financial protection I'd been providing during the marriage. Victoria wanted me to continue absorbing debts that were actually Rachel's, continue paying support calculated on inflated numbers, and continue shielding Rachel from tax complications that resulted from her own business activities. David asked me how I wanted to respond. I thought about it for approximately 5 seconds before giving him my answer. I said I was comfortable with what had been filed. The amended disclosures and tax returns were accurate representations of our respective financial positions and obligations. The original settlement had been based on information that was incomplete, and now that complete information was available, we all had a clearer picture of reality. If Victoria and Rachel wanted to revisit the settlement terms based on this new information, they were welcome to file a motion with the court explaining why they believed the terms should be modified. I wouldn't oppose a hearing where a judge could review the complete financial picture and make appropriate determinations. But I wasn't going to voluntarily agree to continue absorbing obligations that weren't mine or to restore the financial structure that had existed during our marriage. We were divorced. Our finances were separate. The settlement should reflect that reality. David relayed my response to Victoria that same afternoon. She apparently asked whether I'd be willing to have a direct conversation to discuss this collaboratively rather than through attorneys, suggesting that we might be able to reach an understanding more efficiently. David told her I wasn't interested in direct negotiations and preferred to work through counsel and the court system if modifications to the settlement were needed. Victoria's final comment to David was telling. She said she hoped I'd reconsider my position because litigating these issues would be expensive and time-consuming for both parties, and she didn't think it was in anyone's interest to reopen the settlement in a contentious way. David interpreted that as a threat that they'd make the process difficult if I didn't cooperate voluntarily. I interpreted it as confirmation that Victoria knew Rachel's position was weak and was trying to negotiate privately to avoid having to explain to a judge why the original settlement had been based on incomplete financial disclosure. The silence that followed was profound. No further calls from Victoria. No motion filed with the court requesting modification of the settlement. No attempt to challenge the amended disclosures or argue that they were inaccurate. Just silence, which told me everything I needed to know. Rachel and her attorney had realized that they'd negotiated a settlement based on a financial picture that hadn't been complete, and now that the complete picture was visible, they didn't actually want a judge reviewing it because it wouldn't result in terms more favorable than what we'd already agreed to. The response. Over the following weeks, I received several indirect communications that revealed how the financial reality was affecting Rachel's new life with Thomas Ashford. A mutual friend mentioned casually that Rachel had seemed stressed at a recent social event, complaining about unexpected tax bills and financial complications she was dealing with. Another acquaintance said Rachel had mentioned she was looking for employment rather than starting another business venture, which suggested she needed reliable income to cover obligations rather than having the financial freedom to pursue entrepreneurial projects. Most tellingly, I heard through my accountant's professional network that Rachel had hired a new tax advisor to help her deal with the amended returns and the additional tax liability. The advisor had apparently told her that the returns were accurate and that she had no grounds to challenge them, which meant she'd need to pay the $24,000 she owed plus interest and penalties for late payment. Rachel tried calling me directly twice during this period. I didn't answer either call. We were divorced, we had no children requiring co-parenting communication, and the settlement agreement was final. There was nothing we needed to discuss directly. If she had legal or financial concerns, she could address them through her attorney or through the court system. I also learned from a client who knew Thomas Ashford socially that Rachel's relationship with him had become complicated by financial tensions. Thomas was wealthy, but he hadn't expected to immediately absorb Rachel's debts and obligations from her previous life. He'd apparently been under the impression that she was coming out of her divorce in a strong financial position with substantial assets and no significant complications. Discovering that she had tax debts, business obligations, and other financial issues had created friction between them. I didn't take any satisfaction from hearing these things. The emotional wound of the betrayal and the divorce was still too fresh for me to feel anything approaching schadenfreude. But I did feel a sense of calm certainty that I'd made the right decision in stopping the financial protection I'd been providing. Rachel had wanted to extract maximum value from our divorce while leaving behind all the complications and obligations that were inconvenient or difficult. She'd assumed that the protective structure I'd built during our marriage was just how finances worked, not recognizing that it was the result of my active management and my willingness to absorb risks on her behalf. Now she was experiencing what her financial life actually looked like without that protection. The debts were still there. The tax obligations were still there. The consequences of her poor business management and financial irresponsibility were still there. They'd just been hidden when I was covering them. I wasn't attacking her or seeking revenge. I was simply letting reality operate without my intervention. The settlement gave her what we'd agreed she'd receive, but it didn't include an ongoing obligation for me to manage her finances, cover her mistakes, or shield her from the consequences of her own choices. We were divorced. Our financial lives were separate. That separation needed to be real and complete, not a fiction maintained for her benefit. The outcome. The settlement was never formally renegotiated or modified. Rachel and Victoria apparently decided that trying to reopen the agreement through the court system would be more costly and risky than just accepting the reality that the amended disclosures had revealed. Rachel received exactly what the settlement specified: half of our savings, the car, the investment and retirement accounts, and spousal support of $4,000 per month for 4 years. But she also received the accurate allocation of debts, tax obligations, and financial complications that had always been hers, but that I'd been managing and absorbing during our marriage. The net effect was that Rachel's actual financial position post-divorce was significantly worse than she'd anticipated. After paying the additional tax liability, covering her business debts, and dealing with credit card balances and other obligations that I'd been shielding her from, her $450,000 settlement effectively shrank to somewhere around $320,000 in actual net assets. That was still a substantial amount of money. But it wasn't the clean financial victory she'd been expecting, and it came with ongoing complications that required her to actually manage her finances responsibly, rather than relying on someone else to cover her mistakes. The spousal support continued as scheduled. I paid $4,000 per month, directly deposited into an account that Rachel had set up specifically for receiving the payments. The money was automatic and reliable, exactly as the settlement required, but nothing extra. No covering her overdraft fees when she managed her account poorly, no helping with unexpected expenses or financial emergencies. Just the specific dollar amount on the specific schedule, with no additional support or protection beyond what was legally mandated. I restructured my consulting practice to account for the reduced resources and ongoing obligations. The spousal support payments totaling nearly $200,000 over 4 years meant I couldn't invest as aggressively in business development or save as much for retirement. But I'd known that was coming, and I'd planned accordingly. The practice remained profitable and sustainable, and I maintained the professional reputation and client relationships that generated steady income. More importantly, I'd stopped the pattern of absorbing risks and complications that weren't mine to carry. My financial life was my own. My obligations were clearly defined by the settlement agreement and by law, nothing more. I wasn't responsible for Rachel's choices, her debts, her tax issues, or her ongoing financial stability. That clarity was worth more than the money I'd given up in the divorce. It was the end of a relationship where I'd provided protection and support that had never been acknowledged or appreciated, let alone reciprocated. Personal fallout. Rachel's relationship with Thomas Ashford lasted approximately 18 months after our divorce was finalized. The exact reasons for their breakup weren't something I had direct knowledge of, but mutual acquaintances provided enough information to piece together the general arc. The financial complications that surfaced after the amended disclosures had apparently created tension from the beginning. Thomas had been attracted to Rachel at least partly because she seemed to be a successful, financially independent professional who happened to be married to someone who couldn't provide the lifestyle she deserved. Discovering that she actually had significant debts and ongoing tax issues, and that her business ventures had been failures that her ex-husband had been covering up, changed his perception of who she was and what she brought to the relationship. Rachel had also apparently expected Thomas to immediately integrate her into his wealthy lifestyle, supporting her financially while she figured out her next career move. But Thomas had been married before and had learned from that experience to be cautious about combining finances with new partners. He was generous in paying for shared experiences and maintaining the luxury apartment, but he wasn't willing to pay off her debts or absorb her obligations from her previous life. The mismatch between Rachel's expectations and Thomas's boundaries created ongoing conflict. She felt he was being cheap or withholding despite his wealth. He felt she was financially irresponsible and presumptuous in expecting him to solve problems she'd created. They separated about a year and a half after our divorce, and Rachel moved into a more modest apartment that she could afford on her own. The spousal support I was paying, combined with income from a marketing position she'd taken at a healthcare company, was enough to sustain a comfortable middle-class lifestyle. But it was nowhere near the wealthy lifestyle she'd imagined she'd have when she left me for a real estate developer worth $40 million. I heard through a former colleague that Rachel had eventually settled into her job and was doing reasonably well professionally. She'd learned, apparently through necessity, to manage her finances more carefully and to live within her actual means rather than relying on someone else to cover the gaps. The tax issues were resolved, the business debts were paid down, her credit had stabilized. In a strange way, stopping the financial protection I'd been providing had forced Rachel to develop financial skills and discipline she'd never needed during our marriage. She'd had to learn to budget, to track expenses, to make decisions based on what she could actually afford rather than what she wanted. She'd had to experience the consequences of financial mistakes directly rather than having someone else absorb them on her behalf. I never spoke to Rachel again after the divorce was finalized. We had no reason to communicate directly. The spousal support was handled through automatic bank transfers. There were no shared assets or obligations that required ongoing coordination. We'd successfully separated our lives completely. The only indirect contact came when the spousal support obligation ended after 4 years of payments. My final transfer was processed on schedule, and the next month I didn't send anything because the legal obligation had expired. Rachel didn't call or reach out to argue that the support should continue. She'd apparently accepted that our financial relationship was over and she'd need to sustain herself entirely on her own income going forward. Ending, I rebuilt my life and my financial security over the years following the divorce, though the process took longer and required more discipline than I'd initially anticipated. The consulting practice continued to grow steadily, generating income that I could now invest and save without the obligation to support someone else's lifestyle or cover someone else's financial mistakes and business failures. I paid off the mortgage on the condo ahead of schedule, eliminating that monthly obligation and building full equity in the property. I maximized contributions to retirement accounts every year, taking advantage of tax-deferred growth and slowly rebuilding the savings that had been divided in the divorce. I built an emergency fund substantial enough to sustain me through 6 months of expenses without any income, providing a cushion that allowed me to take calculated risks in my business without fear of financial catastrophe. More importantly, on an emotional and psychological level, I rebuilt my sense of self-worth and my understanding of what partnership and marriage should mean in a healthy relationship. The divorce had been devastating not just financially, but emotionally, forcing me to confront the reality that I'd spent 9 years providing financial protection and stability to someone who'd viewed those efforts as nothing special, as just what I was supposed to do, without recognition or gratitude or any sense that my contributions had value beyond the immediate material benefits they provided. I'd learned through painful experience that loyalty and support in a relationship need to be mutual and acknowledged, not one-sided and taken for granted. That protecting someone financially can be an expression of love and partnership, but only when it's recognized and appreciated rather than expected and exploited. That stopping that protection after a divorce isn't an attack or revenge, but simply an appropriate adjustment to the changed nature of the relationship. The amended tax returns and financial disclosures hadn't been designed to hurt Rachel or to punish her for the affair and the divorce. They'd been designed to accurately represent our respective financial positions and obligations, now that we were separate people with separate interests and no continuing partnership. If that accuracy revealed that Rachel's situation was significantly worse than she'd realized or anticipated, that wasn't my fault or my responsibility to fix through continued financial protection and risk absorption. It was simply reality asserting itself after years of being managed and obscured by my efforts. Victoria Chen's concerned call asking to reopen the settlement and adjust various allocations had confirmed what I'd suspected from the beginning. The original deal had been negotiated based on an incomplete and partially inaccurate financial picture that made Rachel's position look better and mine look worse than reality justified. Rachel had walked into those negotiations assuming she understood our complete financial situation and that she was entitled to half of everything we'd built. But she'd never understood the extent of the debts, obligations, and risks that I'd been managing on her behalf, and she'd never realized that those things would become her sole responsibility once we were divorced, and I stopped providing protection. Once the complete and accurate financial picture was visible through the amended returns and disclosures, filed properly with the IRS and the family court, the settlement looked less like a fair division of marital assets and more like a deal that had given Rachel significant value while leaving her with obligations she hadn't fully accounted for and couldn't easily manage on her own. But I hadn't challenged the settlement or tried to renegotiate the terms to my advantage. I'd simply let the accurate information stand, documented and official, and allowed Rachel and her attorney to decide whether they wanted to reopen negotiations in light of the complete financial truth. They'd chosen not to, which told me everything I needed to know. They'd realized that a judge reviewing the complete financial picture wouldn't necessarily give Rachel better terms than what we'd already agreed to, and might actually give her worse terms if the judge concluded that the original settlement had been too generous given Rachel's actual debt load and her responsibility for tax complications from her failed businesses. So the settlement stood as originally written, but with the underlying financial reality now accurately documented and visible to anyone who cared to look at the complete file. Rachel didn't lose because I attacked her or sought revenge or tried to punish her for the affair and the contemptuous way she'd treated me during the divorce. She lost the financial advantage she'd assumed was permanent and unquestionable because I stopped protecting her from the reality of her own financial situation and the natural consequences of her own choices and actions over our years of marriage. During our marriage, I'd been absorbing her debts without complaint, managing her tax complications without recognition, covering her business failures without resentment, and generally making her financial life easier and simpler through my efforts and my willingness to take on risks and obligations that were actually hers to carry. I'd done all of that out of love and partnership and commitment, believing we were building a shared life together where my financial stability and management skills would benefit both of us equally and create a foundation for our mutual future. After the divorce, that partnership no longer existed and those beliefs no longer applied. Rachel had made explicitly clear that our marriage had been a disappointment to her, that I wasn't wealthy enough or successful enough or impressive enough to provide the life she wanted and deserved. She'd found someone who was all those things, someone with $40 million who could offer her the lifestyle she'd always felt entitled to. Fine. She could pursue that relationship and that life. But she wouldn't continue to benefit from the financial management and protection I'd been providing without acknowledgement or appreciation or any recognition that it had value. The amended disclosures and tax returns simply documented reality as it actually existed, rather than the protective and partially fictional structure I'd been maintaining to shield Rachel from her own financial irresponsibility and business failures. The fact that this reality was less favorable for Rachel than she'd expected or understood wasn't something I'd created or imposed on her maliciously. It was what had always been true, just hidden and managed and absorbed by my efforts throughout our marriage. She didn't lose because I attacked her. She lost because I stopped protecting her.